Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good morning, everybody. I kind of forgot that I was going live here. I'm just like relaxing, looking at it. Hey, so I had a pretty good long here earlier today, but it came all the way back. Look at that. Really strong uptrend, and it came all the way back. And by the way, we had some pretty heavy level too, that whole way too. So, yeah, maybe maybe a big whale taking risk off ahead of the FOMC. I don't know. Would make sense since they've been long and they don't know what's going to happen and they want to protect their profits. Maybe. It was a pretty significant flow. You can kind of see over here on my chart. I have a little arrow drawn. Well, it's moved now. Had an arrow drawn. Put it on my Twitter. Right there. You see how there's a really big, strong, heavy offers of 2,000 or so. More on the offer than the bid, and then all of a sudden it's like less than 100. So yeah. And you can see as soon as he left off, it's just been drifting higher again. So it's kind of interesting. I won't have the Texas speech on for this. Out of requests anyways. Oh yeah, Viraj Patel pointing out that we were seeing a drop in the Australian dollar here. I'm not really seeing a whole lot else in the other currencies or anything though. Oil's still up on the day. Treasuries pushed down quite a bit, but I don't know. I don't know what to make of them. They look fairly balanced right here. So I'm not sure if the treasuries have an aggregate position going into this. And here in the E-mini, I don't know if that moved down. I mean, it was the way that it happened, and especially since it was the offers. Because remember that the equity indexes tend to move towards liquidity, not away from it. And in this case, they were moving away from liquidity, kind of suggests that it was somebody was passively selling. And they didn't want to push it down. If that's the case, that would seem to more likely indicate somebody getting out of a position. So that means that we don't necessarily have a solid setup position for the meeting. Okay. So anyways, here we go. We got about a minute left. They are buying up into it. Oh, they're almost back to the buyer's cost basis, in fact, or seller's cost basis, 34.0275. The liquidity is just getting wild. 30 seconds. So remember, we want to see what changed in the statement. Okay, almost there. Wow. Okay. Wait, did that take me out? Did. Okay, no change so far. It took me out, but I didn't get slippage on it, believe it or not. I don't know if the micros did something there or something, but My chart doesn't show me getting touched, but I definitely got taken out. Okay, here's the changes. The probable cell sizes will continue to weigh. Seeks to achieve maximum. Claim on that, buy that. The inflation of 2% over the longer run, including inflation running persistently below the longer run goal, the committee will aim to achieve inflation moderately above 2% for some time. Averages, committee, this is buy. You buy this. This is just gonna skyrocket, guys. Dollar's gonna get crushed here. 6E is moving up. The euro is really moving. Come on. Bit deeper and sooner of a pullback than I expected. Is this Baby Asher's daddy's channel? I missed Baby Asher Day. You did, but you can still watch it on replay. Sure, whipsawed. Well, this is being incredibly frustrating. Hmm. So coming back to the moving average. Wait, what? Something's wrong. do think that they'll break the high of the day at some point, but it looks like uh, they're just having a hard time doing that for whatever reason. They just want me really bad today, man. Fuck. Well, that's FOMC for you, isn't it? Well, I'm surprised that they're having a hard time even them holding 340250. That's where I would expect them to be going and staying above. And again, the statement very much was we want full employment and inflation over 2%. I think that it was the most dovish change in the overall statement that you could possibly make. Look at the E-mini battle in it there. Huh. Okay. So they picked back up a lot of cluster volume there at O2, but it looks like they're pushing through them this time. No, not quite. Overall cumulative delta is selling now. That's interesting. Well, it's selling from the initial big move up. It's sold, but oh, guys, can we just catch a break today? Hmm? So it's been about 10 minutes now. Hmm. Hmm. It's a lot of volume trading there. Gold is selling. So what I saw as initial is actually reversing in some of the instruments. Uh, do see that 2 members voted against the hold on policy action, but that might have been because they wanted to increase the size and duration of purchases. I don't know how that works. So it's not just they. Anyways, I could be wrong about that. Okay, so then back to this volume cluster area here again. Let's see if they are able to push through it this time. It's looking a little bit more encouraging. Yeah, 03. Able to break it. Cool. Okay. Let's see here. Drunk face. Russell skyrocketing. Waiting for extreme tick never came. Boring day. Let's move this over here so I can actually read you guys' comments because I can't very well over there. Discord doesn't matter as much. We can leave that over here. $33.88, $34.12. Pick up outside that range. Yeah. I think that 34.16. Well, really, the overnight high 34.18 is probably where I would expect it to go. We only have 15 minutes before the meeting, though, so. Now, the treasuries actually, the 30-year in particular, sold off of that. Sold down on the initial move. Always seems to slow down when you get an order out there, doesn't it? Okay, I guess Kaplan dissented is the one of the stories that I'm hearing. I've seen dissensions in the past before and them just not ending up mattering. So they bought morning dip too, so maybe you need to get over day high. Yeah. Well, like I said, I felt like that the move that we had all this morning before lunch, retracing the morning move, must have been somebody exiting a trade because they used limit orders. It was unusual for um, the equity indexes to behave in the manner that they did. So Yeah. What more can I say about it? So there's the new high. Well, I tell you what, man. That was the most. I don't think I've ever sweat through a trade more than that, man. I am so glad that I stuck to my guns because I was fucking terrified that whole trade, man. I was terrified through that whole trade. Okay, it's the stops. Here's the stops. That's right. Might be a little bit more, but fine. There we go. What a fucking day. Oh my god. How many trades did I take there? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That's not right. Oh, no, 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 no. We're good. We're good. It's coming back a little bit. How are you guys doing? I can't see the monster in the background. Oh, yeah, you're right. What can we do about that? How many ticks did I take on that? 54? It was actually just as good as the one that I caught earlier today. That one, though, I let come back. Can you believe? And the other thing is the MES fucked us over. Let's see if we can show you here. MES 1 minute. Okay. Shit. What the fuck? Oh my god. Do you see? Oh my gosh. Well, that was dumb. I'm not doing that again, but my gosh. Look at the micros. What a load of shit. The micros went all the way to 83. What? You didn't expect something? Yeah, you know what? You had to know what machines did in the morning. They bought the dip. They probably added in now we're exiting with people buying some dark pool stayed clear in the morning. Yeah. I think that I mean, get me wrong. Oh my gosh, you can see my window there too. I'm embarrassed by just to be I mean frank with you guys, I'm embarrassed to show you that. I'm embarrassed to show you that. I don't know why that's red, but I made $60 today. But I made $60 because when it first of all, I don't know how I ended up being long 3 contracts there. But I guess I must have had a limit order that got filled that I didn't realize it. So then I'm holding it and it's going against me and I'm like, it's a long though. I know it is. I know it's a long. This is like you could just get in and it'll just go. Well, it didn't just go, but I was right. I mean, I stuck with my guns. I'm happy I did. That was very risky though. And they were live trades too. So I yeah. I'm a little irresponsible. Uh, how do you put this? The actions in this video are performed by trained professionals and involve extreme risk. I just man. Well, okay. How do we put that one in there, man? Now, not only is that we come out profitable today, but that's also a new high for this portfolio since we refunded it. So, well, I shouldn't really say since we refunded it, but since we started doing stuff in September. So happy, I guess, but this is so stressful. I feel like I just went through a traumatic event. Ugh. You're probably Gary Rich is probably sitting out there like rolling his eyes, like, dude, if you thought that was stressful, okay, it was stressful for me. All right, I was just a little bit miffed about that long we had it in the morning coming back. And then once I read this statement, I mean, you saw how I did it, right? I remember I explained you want to look at this, you want to know enough about this statement. So what was I doing? I was reading through here. The committee seeks to achieve maximum employment, blah 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 blah, inflation at a rate of 2% over the long run, blah 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 blah. Inflation running persistently below this longer term run goal, the committee will aim to achieve inflation moderately above 2%. That was it. That was buy. I don't care where it is. I don't care what's happening. I probably didn't get the best spot. I don't care what else is in the statement. You buy that. And it worked. So crazy shit. How'd you guys do? You doing okay? Twitter's being a little, well, my YouTube is not being all hunky dory with me here. To Vlad's point that the dark pool stayed clear in the morning, I'm there. It looked like there was a little bit of nonsense going on here, especially when did the stream die for some of you? Oh, maybe Igar was streaming. You're adding to shorts? Hmm. Hmm. YouTube is dying on me. It says I'm still connected. I hope you guys are still there. Yeah, YouTube is like, if I go to YouTube, it just doesn't load for me. Google's not loading for me either. But it says I'm still connected. What the heck? And the router's okay. Okay, whatever. You know what? I should come back over here and try and understand what I did. Because, let's see here, orders. They say that they're all pending. There we go. They're filled. Okay. Oh, I did put 3 in there. I think what happened was I clicked down here to get in at 09. Oh, no, it wasn't at 09. Those were the exits. It was. How come it doesn't show me the. I'm missing a column. Hold on a second. Column chooser. Oh, there it is right there. Okay. So I got 2 at 02. 2 at 02. And then I got 1 at 08. So I actually only intended to do 2 orders, and I think I clicked twice, and so I got filled on 3. And then I took that 1. I could have taken from 09 to 15. That would have been $30. But... And you know what? I got out at a great spot. Got out at a great spot. All right, let's see. Can I see you guys over here in live chat now? No, it's still being a pill. It's still being a pill. I apologize. Move this. Fix this. Okay. That's still not working. That's so weird. Okay, now I can see you guys chatting. Salim L Wondering says, why was it stressful? Because I was long 3 contracts and I was down like 8 ticks and I didn't intend to be long 3 contracts and I knew that it was a buy, but that was like way more excursion than I was planning on having. Yeah, oh, look at that. Look at them come back up there quick. I didn't think they would make it before the Federal Reserve meeting, but you know, whatever. You don't want to be in during that, though. Let's turn on the sound here.
As strong as possible.
He's chatting.
And to limit lasting damage to the economy. Okay. Today, my colleagues on the Federal Open Market Committee and I made some important changes to our policy statement, including an update to our guidance for the likely path of our policy interest rate.
Is that good? Volume's all good, guys.
On longer-run goals and monetary
Somebody
policy
needs
strategy
to put a compressor on Mr. Jerome.
These changes clarify our strong commitment over a longer time
Maybe
horizon.
It's, you know, I should have a de-esser.
Before describing today's policy actions, let me briefly review recent economic developments.
He's talking. As good as it gets.
Economic activity has picked up from its depressed second quarter level, when much of the economy was shut down to stem the spread of the virus. With the reopening of many businesses and factories and fewer people withdrawing from social interactions, household spending looks to have recovered about 3/4 of its earlier decline. Nonetheless, spending on services that typically require people to gather closely, including travel and hospitality, is still quite weak. The recovery in household spending also likely owes to federal stimulus payments and expanded unemployment benefits, which provided substantial and timely support to household incomes. Activity in the housing sector has returned to its level at the beginning of the year, and we are starting to see signs of an improvement in business investment. The recovery has progressed more quickly than generally expected, and forecasts from FOMC participants for economic growth this year have been revised up since our June summary of economic projections. Even so, overall activity remains well below its level before the pandemic, and the path ahead remains highly uncertain. In the labor market, roughly half of the 22 million jobs that were lost in March and April have been regained as many people return to work. The unemployment rate declined over the past 4 months, but remains elevated at 8.4% as of August. Although we welcome this progress, we will not lose sight of the millions of Americans who remain out of work. Looking ahead, FOMC participants project the unemployment rate to continue to decline. The median projection is 7.6% at the end of this year, 5.5% next year, and 4% by 2023. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, the high level of joblessness has been especially severe for lower-wage workers in the services sector, for women, and for African Americans and Hispanics. The economic dislocation has upended many lives and created great uncertainty about the
J-Bow is
future.
getting old. Or he was always old, man.
The pandemic has also left a significant imprint on
He looks like he is getting a little older, doesn't he?
for some goods, including food, supply
Sure, this has been
constraints have led
stressful
to
on him.
notably higher prices, adding to the burden for those struggling with lost income. More broadly, however, weaker demand, especially in sectors
that didn't
have
give
been
them a
most
new
affected
overnight
by the
high?
pandemic, has held down consumer prices. And overall,
What were you
inflation
saying,
has
Vlad,
run
about
well
nobody
below our
hedged on the
2%
way down?
longer
How do
run
you
objective.
determine that?
The median inflation projection from
Salim says my
FOMC
armpits are still
participants
stinking.
rises from 1.2% this year
I'm probably
to
gonna smell by the
1.7%
time,
next year, and reaches 2% in
by the
2020.
time workout comes along.
As the economy began its
Same-
recovery, COVID-19 cases, hospitalizations, and deaths also rose. The reimposition
Wait,
of
Vlad,
some
you
social
in
distancing
short
restrictions,
snow
as
with
well
the
as more cautious
CFD?
behavior by many individuals
What?
have succeeded in slowing the spread of the virus. As we have emphasized throughout the pandemic,
Are you getting
the
rich
outlook
now?
for the
No.
economy is
Just a
extraordinarily
little bit.
uncertain and will depend in large part on our success in keeping the virus in check. All of us have a role to play in our nation's response to the pandemic. Following the advice of public health professionals to keep appropriate social distances and to wear masks in public will help get the economy back to
And it was CFDs. You can short IPO. I don't trade
a full
CFDs.
economic
No, it can't.
recovery
Oh.
is unlikely until people are confident that
I
it
tell
is
you
safe
what,
to
that whole
re-engage
snow
in a
thing
broad
is
range of
pretty wild,
activities.
isn't it?
The path forward will also depend
I really
on
want
the
to know, though,
policy
if
actions
any
taken
of you can
across
tell
all
me,
parts of the government to
or if you
provide
find
relief
out
and to support the recovery
when
for as long
Sumo
as
Logic
needed.
is doing their IPO
The Federal Reserve,
and which
response
brokers
to this
have it, I
crisis has
would
been
like
guided
to know.
by our mandate to promote maximum
I'm not
employment
saying that
and
it's a
stable
buy or
prices for the
anything, but
American
I'm
people,
more interested in
along
that
with
than
our
the other IPOs
responsibilities
are
to
now.
promote the
We use
stability
that.
of
It's
the
a good
financial
product.
system. We remain committed to using our full range of tools to support the
It's a
economy in this
.com
challenging
pump. Yeah.
time.
It was nuts. Well, it's not just
The
that.
changes we
It's
made
those
in
Wall
today's
Street
policy
bets
statement
idiots.
reflect our strategy to achieve
The
our dual mandate
degenerate
goals by
gambler
seeking to
club.
eliminate shortfalls from maximum employment
They're worse than
and achieve
degenerate
inflation
gamblers.
that
I don't even
averages
know what to
2%
call them.
over time, as we articulated in our statement on longer-run goals and monetary policy strategy. We view maximum employment as a broad-based and inclusive goal and do not see a high level of employment as posing a policy concern unless accompanied by signs of unwanted increases in inflation or the emergence of other risks that could impede the attainment of our goals. And we believe that achieving inflation that averages 2% over time helps ensure that longer-term inflation expectations remain well anchored at our longer-run 2% objective. In turn, well-anchored inflation expectations enhance our
Yeah,
ability
they
to
all
meet
bought
both
it,
our
and then they
employment
sold
and
'cause it went too
inflation
far?
objectives, particularly in the new normal in which interest rates are
Well,
closer to their
yeah,
effective
pure
lower
gamblers.
bound,
Because
even
I
in
think
good
they
times.
didn't price it right. If they priced it
As
right,
we
it
see in
wouldn't
our
go
statement,
below what it
with
opened at.
inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these outcomes, including maximum employment, are achieved. With regard to interest rates, we now indicate that we expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, over coming months, we will continue to increase our holdings of Treasury securities and agency mortgage-backed securities, at least at the current pace. These asset purchases are intended to sustain smooth market functioning
In
and
Discord,
help
they're
foster
using the
accommodative
Sept
financial
mechanics.
conditions, thereby supporting the flow of credit to households and businesses. We believe the strong
Let's
policy
buy it
guidance we
all.
are providing today will serve the economy well by promoting our goals.
As long as that man is
The
talking,
recovery may take.
Of
course, as
bad
we note in our
things
policy
happen when
statement,
he's
we will
talking.
be prepared to
That's
adjust the stance of monetary policy as appropriate.
certainly
risks
couldn't
emerge
get
that
in
could
here.
impede the attainment
I
of our
suppose I could
goals.
still be long and just holding it.
The Federal
But
Reserve has also been taking broad and forceful
let's buy
action
all
to
of the
more
treasuries and
directly
own
support
America.
the
Oh,
flow of
I'm
credit
totally down
for
with that.
households, for businesses,
Move over,
and
Japan.
and for state
Vlad and
governments.
Seth are going to become the new
Restoring the
largest
flow of
holder
credit
of
is
treasuries.
essential for mitigating the damage to the economy and promoting a robust recovery.
You know what? We'll buy it all.
Many of our programs rely on
Squeeze them and
emergency powers that
everything.
require the support
Really
of the
play the
Treasury
markets with it and
and are available
everything.
only in
You
very
know,
unusual
be
circumstances,
really
such as
mean
those we
about
find
it.
ourselves in today.
Like, oh my gosh, guys.
These programs serve as a
we
backstop
own all
to
the
key credit
treasuries,
markets and appear to
but
have
you haven't
restored
been
the flow
very
of credit from
responsible.
private lenders through normal channels.
You're not being very responsible. We might just sell them all, and the market will panic, and we'll make money off of it. And
enabled in
everything.
large part
And then
by
at the end of it
financial
all,
backing and
we'll
support
just
from
forgive
Congress
the U.S.
and
of
the
all of
Treasury.
its debt.
When the time comes, after the crisis has passed,
do
we will
it.
put these emergency
Junk
tools
bonds.
back in the toolbox.
We just getting started. Give us more talk. Yeah.
As I've emphasized before, these are lending powers, not
Oh,
spending
man.
powers. The Fed cannot grant
Okay,
money to
but
particular
so on
beneficiaries.
another note, if
It can
anybody
only
from the
create
Federal Reserve
programs
is
or
watching, you
facilities
really
with
need to do
broad-based
something about
eligibility
Mr. Powell's
to make loans to
voice
solvent entities with the
chain
expectation that the loans will be
on his
repaid.
his
Many
audio chain.
borrowers are benefiting
Like,
from
it doesn't
these
sound like he
programs
really
as
has
the
a
overall
compressor
economy.
on him. It's
But for many
clipping.
others, getting a loan that may be difficult to
It's
repay
just not.
may not be the answer.
It's just
In
not
these
very good
cases,
sound.
direct fiscal support may be needed. Elected officials have the power to tax and spend and to make decisions about where we, as a society, should direct our collective resources. The fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. Even so, the current economic downturn is the most severe in our lifetimes. It will take a while to get back to the levels of economic activity and employment that prevailed at the beginning of this year, and it may take continued support from both monetary and fiscal policy to achieve that. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We are committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible. Finally, I would like to take a moment to recognize the passing of our friend and colleague, Thomas Laubach. His outstanding analysis and advice have been indispensable to the FOMC and have played a key role in the policy decisions that will define this era of the Federal Reserve. He will be remembered for his intellect, but also for his kindness, his equanimity, and his dedication to achieving our mission on behalf of the American people. We will miss him.
I heard Federal Reserve.
Thank you.
Talking
I'll
about
now
me?
be glad to take your questions.
No, it was me and Vlad. You can join us too, Salim, if you want to
Thank you,
contribute.
Nick Timrose.
You contribute.
Good afternoon, Chair Powell. Nick Timrose from the Wall Street Journal. You've been very clear about the committee's intentions on rates, not even thinking about raising rates, and today showing low rates even as unemployment falls to 4% and inflation rises to 2%. My question is about asset purchases. Does the guidance today apply to the current asset purchase pace, are there any macroeconomic conditions under which you would favor
He needs to stop
increasing
talking. I
the
can't
monthly
short
pace
anything
of
when he
Treasury
talks
and
with
MBS
such confidence.
purchases? And under what conditions would a decrease
Right.
in the monthly
Okay, they
pace
did
of
finally get
purchases
the
be
overnight
appropriate? Thank you.
high.
Thank you. So
I'm still happy with where I got out.
Meeting statement that we'll continue to increase our securities holdings at least at the current pace over coming months to sustain smooth market functioning and help foster accommodative financial conditions.
Why does he
That
look
latter
like
part
what
is
exactly?
an updating of our guidance to
Old?
reflect what I've been saying in these press conferences for some time and what other central banks have acknowledged, which is that the purchases are fostering accommodative financial conditions as well. That amounts to
Here's
roughly
my
$80 billion on
thing.
Treasuries and $40 billion net.
Here's another
on
thing I
foreign
want to
ABS.
point out.
So we
All right.
do think that these purchases have been
What
effective.
the hell is
in
this?
restoring orderly market
Is that a
conditions
half
and
Windsor?
support the flow of credit to
You
households,
seriously, pal?
including by fostering more
You're
accommodative financial
the
conditions, which, of
the
course,
most powerful
we think is
man in finance.
So,
You're wearing a half Windsor? What?
in terms of going
Come
forward,
on.
I would just say this.
It's a really
There are
poorly one.
various
It's a really
ways in
poorly
which
done
we
one
can adjust
too.
our tools going
Like, come
forward,
on.
and we'll continue to monitor developments.
We're gonna have to
and
tweet
adjust
about.
our
We're gonna have to
plans
tweet
as
about this.
appropriate.
If I could
We're gonna have to
follow up,
tweet about
I
this.
suppose the question I have is why give guidance on one policy tool but not give guidance on the other policy tool when the Fed has talked about those two policy tools working together?
So we think our policy stance is appropriate today, and we're prepared to adjust it going forward as we see appropriate. And today, we believe that particularly this very strong forward guidance, very powerful forward guidance that we've announced today, will provide strong support for the economy. Effectively, we're saying that rates will remain highly accommodative until the economy is far along in its recovery, and that should be a very powerful statement in supporting economic activity. Now, we're buying $120 billion in securities per month across the Treasury curve. That's also adding to accommodation. We do have the
I'm
flexibility.
just saying,
to
bully him,
adjust
Sept.
the
This guy,
tool
his
and the
eyes,
rate
no
tool
one.
and
The
other
one who
tools as
asks
well.
him
But
questions.
as
No,
for
I
right
don't.
now, we think that our policy setting is appropriate to support the expansion. We said from the beginning that we would first try to provide some support and stability and relief in the first phase of the crisis, the acute phase, and then we would support the expansion when it came. Well, it's here, and it's well along, and so that's why we changed our guidance today, and we do have the flexibility to do more when we think it's appropriate.
Thank you.
Thank you, Gina.
Going to use capitals.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilik, New York Times. I was wondering, you beefed up your language on financial stability in the long-run statement that you unveiled with your Jackson Hole speech last month. I'm wondering if you could kind of walk us through how you think about financial stability concerns as a factor in guiding future rate increases. You know, would financial stability concerns on their own be enough to merit changes in the Fed funds rate, or would they have to come in conjunction with an overheating on inflation or some sort of dramatic drop in the unemployment rate? If you could just sort of give us an outline of your thinking there, please.
So what we said in our statement on longer run goals
FOMC.
and monetary policy strategy was that the committee's policy decisions reflect its longer run goals, its medium term outlook, and its assessment of the balance of risks, including risks to the financial system that could impede the attainment of the committee's goals. So that's what we said about financial stability.
We need to make a video about
And
this.
today we said that we'd be.
I know
prepared
it'll
to
be
adjust
silly
the
stuff.
stance
This
of
can be
monetary
our
policy
Friday
as appropriate
video.
if risks emerge that could impede.
Well,
the attainment of
we
our
can
goals.
make one for tonight.
But you asked specifically about financial stability.
Just like, come on.
One thing I would say is that monetary policy should not be the first line of defense. Is not the first line of defense on financial stability. We look to more appropriate tools in the first instance as a first line of defense, and those would be regulation, supervision, high
There was
capital.
a small
high
amount of
liquidity, stress
USD strength
testing,
when Powell indicated that QE
all of
levels
those
are
things,
appropriate.
macroprudential tools, all of those things are.
Okay,
really
so
the
that
first
is,
line of
even though
defense
we
on
went
financial
up, and I
stability,
really
but
think
we,
that the move up
we
is
always leave
justified,
open the idea
I do
that
think
we
that
will
there's
not
something really
ignore
important that we
those
make a
kinds of
note of,
risks
right?
and
And that
other
is that
risks
it
more
does not appear at the moment
could
that
impede the attainment of our goals.
increasing
monetary
the size and duration
So
of
that's really,
treasury purchases
how we think
is
about it.
happening.
But principally,
And as a result,
other
we are
tools
seeing the
front
treasuries
line,
are
as I
moving
mentioned.
down quite
I
aggressively.
guess, but
The
just to follow
30-year
up
in
quickly, if
particular
markets
is
hold
just
on
getting
with
destroyed.
financial
Almost a
stability
whole,
concerns
almost
in
a
and of
whole
themselves
point
be enough to
down
warrant a
in
rate
the
hike.
Treasury.
So
Let's come out
what we
here and
said
look at the
what we said in
volume
the
profile of it.
longer run, in our consensus statement is
Oh,
that
there's so much
we,
further to go.
policy
Yeah.
decisions reflect
So that's
the balance of risks, including
going
risks
to be
to the financial
important.
system that could impede the attainment of the committee's goal. So the test would be, does a majority of the committee feel that that monetary policy is triggering that, and that would be the test. And it's not something that we've done. We do monitor financial stability concerns, of course, intensely and regularly. We try to use our other tools on them, but we do keep them in mind as we think about monetary policy.
Thank you.
Thank you. Steve Leisman.
Mr. Chairman, I wonder if you could help me understand how the projections of the committee line up with the goals of the committee. You've now altered the projections to the statement to aim for inflation above 2%. But when I look at the SCP, I don't see the committee believe in a single year in the next 4 years that you are ever above 2%. In fact, for each year, you are below it until 2023 was the first time that you actually hit 2%. So do you think, are you confident? Does this suggest the committee is not confident that not only can it not hit its 2% goal, but that now it can't hit its goal of being above 2%?
Not at all. You also don't see people, by and large, lifting off or raising interest rates above zero. I guess there are 4 exceptions out of a committee of 17 during the forecast period. So we don't reach 2%, but we get very close to it in the forecast. We reach 2%. I guess the median is 2% at the end of 2023. So you know what the guidance says. It says that we expect that the current setting of our rates will be. We expect that it will be appropriate. Until such time as we reach 2% inflation, that we feel that labor market conditions are consistent with our assessment of maximum employment, and that we are on
we got a good trade there in the E-mini, but
moderately above. So that's
the
test.
30-year bond was a real
conflict
trade,
between
man.
those two, because
30-year bond dropped a whole point.
The way they're set up, the projections don't show the out years. You ask about confidence, and I would say that this very strong, very powerful guidance shows both our confidence and our determination. It shows our confidence that we can reach this goal and our determination to do so.
And the E-mini trade was pretty volatile too, whereas the treasuries, they were pretty one-directional.
Its new goal of aiming for inflation above 2%. Why wouldn't one of those years at least show
Steve, get a real audio system
on the median forecast?
Because we think, looking at everything we know about inflation dynamics in the United States and around the world over recent decades, we expect it will take some time. We expect that the economy will recover quickly now, but that pace will slow as people go back to work, and we'll still have an area of the economy, a big area of the economy, that struggles. There'll be slack in the economy. The economy will be below maximum employment, below full demand, and that will tend to put downward pressure on inflation. So we think that once we get up closer to maximum employment, we think that inflation will come back generally. And that's sort of what happened during the last long expansion. It's a slow process, but there is a process there. Inflation does move up over time.
We'll just tell
CNBC. We do expect that will
CNBC.
continue today, and we expect that our guidance is powerful and will help that outcome. We think that effectively saying that policy will remain highly accommodative until the economy is very far along in its recovery should provide strong support for the economy and get us there sooner rather than later.
Thank you.
Thank you. Rachel Siegel.
Hi, Chair Powell. Thanks very much for taking my question. I wanted to ask if you anticipate a slowing in the pace of the recovery if there is not another stimulus package, and specifically if there are particular holes still remaining in the economy that you think could be helped by more aid from Congress. Thanks very much.
Sure. So first, if you look at the summary of economic projections that my colleagues and I filed for this meeting, what you'll see is an expectation that the recovery will continue, that it will continue at a reasonable pace through 2021, 22, and 23. We do expect that pace will slow, just because you would expect that the pace would be fastest right at the beginning of the right at the beginning of the recovery, because you had such a sharp decline. You would expect that the third quarter should be the fastest gains, and that after that the pace should slow down to a more normal pace. So we do expect that. In terms of fiscal policy, you ask about fiscal policy. So, one thing, I guess I would start by saying that the initial response from fiscal authorities was rapid, it was forceful, and pretty effective. And we're seeing the results of that today in the income and household spending data, in the labor market data, in the construction data, in the data for business equipment spending, and the fact that businesses are staying in business, and the pace of defaults and things like that has really slowed. So there's been a really positive effect. That said, my sense is that more fiscal support is likely to be needed. Of course, the details of that are for Congress, not for the Fed. But I would just say there are still roughly 11 million people still out of work due to the pandemic, and a good part of those people were working in industries that are likely to struggle. Those people may need additional support as they try to find their way and through what will be a difficult time for them. We've also got struggling small businesses, especially those in the business of facing directly to.
Well, I don't know. It seems like the overall up move is right, but look, it's coming back quite hard.
Spending has gone up,
and
much of it related to the pandemic and economic effects. So again, I would say the fiscal support has been essential in the good progress.
This might be like overall positive, but then like tomorrow we sell or something.
Just about all, the overwhelming majority of private forecasters who projected
where's the stimulus bump you promised?
Recovery are assuming there will be a substantial additional fiscal
if we get another stimulus, Steve Leishman needs to buy a new microphone. Do you see this guy? You had one of those little things like you use for your phone? What?
Should we expect any
Really?
further evolutions in forward
Man.
guidance? Say maybe
It feels a little weird to have a better computer audio setup than CNBC newscasters. Oh, that was a big old monster.
I think that the forward guidance we adopted today is
Look at that.
appropriate and, as I mentioned,
buying some dips here.
Effectively, what it says is that we will keep policy where it is now, keep the rate policy where it is now, until unemployment reaches the committee's assessments or levels that are not unemployment, labor market conditions reach levels that are consistent with the committee's assessments of maximum employment, until inflation reaches 2% and until it's on track to go above 2% moderately for some time. So that's very strong forward guidance, and we think that will be durable.
Strong forward guidance. He's
guidance
right.
that will provide significant.
You know what it means? It means they're never going to raise interest.
That's really our thinking on forward guidance on rates.
34.12 failed to hold. Yeah. So I have 34.03.
Thanks, Chair Powell, for doing this.
See if they get to 33.98 or
describe
so.
this guidance as durable. You've set up a three-part test here for rate hikes. Levels consistent with assessments of maximum employment. Inflation has risen to 2%, and you're on track to moderately exceed 2% for some time. Each of these have modifiers, and I wonder if you'd explain them a little bit more. How do we pin down assessments of maximum employment? When you say that inflation has risen to 2%, does that mean 2% for a day, a month, 6 months? And when you say on track to moderately exceed, how should we define moderately, and how should we define for some time?
So, as you know, maximum employment is not something that can be reduced to a number the way inflation can. It's a broad range of factors. It really always has been, and really substantial number of factors that we've indicated we would look at. So it's broader labor conditions consistent with our committee's assessment of maximum employment. So that would certainly mean low unemployment. It would mean high labor force participation. It would mean wages. It would be a whole range of things. And we're not looking at a rule. We're looking at a judgmental assessment, which I think we'll be very transparent about as we go forward. In terms of inflation, this is a committee that is both confident and committed to and determined to reach our goals. And the idea that we would look for the quickest way out is just not who we are. It's not that there's no message of that here. We would not be looking for 1 month of 2% inflation. We said return to achieve 2% inflation. Okay, so just understand that we're strongly committed to achieving our goals and the overshoot. So that should tell you about that.
I'm having a lot of fun typing here, man.
So what does moderate means? It means not large. It means not very high above 2%. It means moderate. I think that's a fairly well understood word. In terms of for a time, what it means is not permanently and not for a sustained period. We're resisting the urge to try to create some sort of a rule or a formula here, and I think the public will understand pretty well what we want. It's actually pretty straightforward. We want to
maximum employment, not a single number like inflation.
Over time.
Oh,
and if we
really?
do that, inflation expectations will be right at 2%, and that'll help us achieve 2% inflation over time and avoid the situation where the central bank loses its ability to support the economy.
Thank you. James Politi.
Thanks for taking the question. James Politi with the Financial Times. Do you consider today's
yet another journalist that really needs to do something about his
accommodation to the U.S. economy from a monetary perspective, and sort of delivered further support for the economy, or is it just a tweak to your existing policy stance? And in terms of fiscal support, do you assume in your own projections, not just private forecasters, that additional fiscal support will be forthcoming, or do you expect a weaker growth or a larger contraction rather this year if no fiscal support is forthcoming?
So in terms of the effects, so I think what we've done is more or less aligned with the consensus statement today. So it's in line with what might have been expected. As I mentioned, I think over time it will provide very powerful support for this economy as we move forward. In a sense, it's consistent with expectations. So I'm not looking for a big reaction right now, but I think over time, again, guidance that we expect to retain the current stance until the economy has moved very far toward our goals is a strong and powerful thing. And I think that will be supportive of the economy over time. In terms of additional fiscal support, I guess your question is what would happen if, people have different assessments, and different participants in the FOMC made different assessments on their own. I think broadly, though, there is an expectation among private forecasters and among FOMC participants that there will be some further fiscal action, and there does seem to be an appetite on the part of all the relevant players to doing something. The question is how much and when. And so I would just say that if, and it's very hard to say, that so far the economy has proven resilient to
Zero Hedge
to the
interpreting
lapsing
his
of the,
comments that he
to
just
the,
had
the
as,
CARES Act unemployment.
we no longer have any idea what is going on, but if
benefits.
stocks drop, we will print more money.
There's certainly a risk, though, that that those who are unemployed appear to have saved some of those benefits, and they'll now spend them, and that as the months pass, if there's no follow-up on that, if there isn't additional support, and there isn't a job for some of those people who are from industries where it's going to be very hard to find new work, then that will start to show up in economic activity. It'll also show up in things like evictions and foreclosures and things that will scar and damage the economy. So that's a downside risk. So I think the real question is when and how much and what will be the contents. And no one has any certainty around that. But broadly speaking, if we don't get that, then there would certainly be downside risks certainly through the channel I mentioned.
Thank you. Anakin, CNN.
Thanks for taking my question. Chairman Powell, given the recent update to the policy framework and repeated calls for this in the Fed Listens event, is the Fed open to other measures of the economy, such as income inequality and affordability of housing?
So we monitor everything we think is important in the U.S. economy. And in a broad sense, all of it goes into thinking about monetary policy. You mentioned inequality. So, disparities in income and in financial well-being by various demographic and racial categories, something we monitor carefully. Inequality, which I would point to, it's a multifaceted thing, but I would point to the relative stagnation of incomes for people at the lower end of the income spectrum, and also lower mobility. So those are things that hold back our economy. They are. The thing is, we don't really have the tools to address those. We have interest rates and bank supervision and financial stability policy and things like that, but we can't get at those things through our tools. When we lower the federal funds rate, that supports the economy across a broad range of people and activities, but we don't have the ability to target particular groups. Notwithstanding that, we do talk about it because these are important features of our economy, and I think those distributional issues are issues that are really for our elected officials, and I would say I take them seriously as holding back our.
I'm going a little
productive
manic with the
capacity of
commenting and stuff right now. I'm
is
sorry with
limited
all the
when
typing.
not everyone has the opportunity, has the educational background,
What does it have to do
and
with
the health care and all the things that you need to be an active participant in our workforce. So I think we can, if we want to have
It's like they did kind of
highest
hold
potential
the
output
seller's
and
line.
the best output for our economy.
So it
we
looks
need
like
that
the buyers are
prosperity to
firing
very
back
broad
here,
spread
but
in the longer run. And I would just say
they definitely absorbed on that one too.
And in when we think about maximum employment in particular, we do look at individual groups. So the high unemployment in a particular racial group like African Americans, when we would look at that as we think about whether we're really at maximum employment. We would look at that along with a lot of other data. So the answer is we do look at all those things and do what we can with our tools, but ultimately these are issues for elected representatives.
Thank you. Edward Lawrence.
Yeah, thank you, Chairman Powell, for the question. I just wanted some clarity here. At what point do you think it's prudent to shift the bond purchases from market?
There we go. Edward Lawrence. This is my man. Look at you. You've got a nice tie. It's tied nice and square. Maybe it needs to be pulled up a little bit. Good microphone. You don't have the best camera, but you know what? It's a Zoom call. It's okay.
Clearly, there's been great progress in terms of market function. If you remember early in the spring,
That's
when
what we should be.
Of the pandemic hit, market function was very low, and it's improved rapidly, and in many respects is in a good place now. We also, though, think that these asset purchases, which total 120 billion a month, which is much larger than for example the last asset purchase program during the global financial crisis and the recovery therefrom. We think that that's also providing accommodative financial conditions and supporting growth, and we think that's fine. We're also aware that there are ways we can adjust that, to do various things, make it smaller, make it larger, and also target different sectors of the curve. And we're going to continue to monitor developments, and we're prepared to adjust our plans as appropriate.
Thank you. Victoria. Victoria Guida.
Hi, thanks for taking my question. I wanted to ask about a couple of things. First of all, if we don't get a vaccine until well into next year, what does that mean for the economy? And then somewhat related, I was wondering if you could provide any more detail about the stress scenarios that you all are going to release for the big banks and whether that is going to be another full-blown stress test, whether we're going to publicly see those results and what it might mean for bank payouts.
Great. So on the first one, what's happening is basically we're learning to live with, right now, we're learning to live with COVID, which still spreads. And we're learning to engage in economic activity. All of this recovery that we've seen is in a context where, where people are still at risk of catching it. And yet we're able to resume lots and lots of economic activities. And that involves, as I mentioned, I think the more social distancing we can preserve as we go back into the workforce, wearing masks, keeping our distance, that kind of thing, the better we'll be able to get economic activity back up close to where it was. I do think, though, there are areas of the economy that are just going to really struggle until we have a vaccine that's in wide usage and is widely trusted. And those are the ones where people were getting really close together. I also think testing, to the extent you have cheap and rapid testing, you can do a lot with that in the workforce. You can build confidence in the workforce if you have very regular testing. It doesn't cost very much, and you get the results really quickly. If you do that, you'll be able to open a lot of workforces, particularly in cities where the overall case numbers are quite low, and that will help a lot. So I think we're going to be finding lots and lots of ways to get out towards, as far as we can. There's always going to be that for some time. There's going to be certain activities that will be hard to resume. So I think that's the only way I can say it. And I think trying to, when we make a forecast, we make assessments about that. But it's really hard to say. There's no template here. There's no, there's no experience with this. So frankly, for the last 60 days or so, the economy's recovered faster than expected. And that may continue or not. We just don't know. And I think we should do those things that we control to make sure that we can recover as quickly as possible. And the main thing, again, is wearing a mask and keeping your distance while you're in the workforce. That's something we can all do that will limit the spread and let people go back to work, avoid major outbreaks and things like that. In terms of the stress test, so I really don't have any, we're getting ready quite soon to be making announcements and saying things publicly. There's not much I can say with
His tie is choking him. No, it's
really that I can say that's on that today. I don't have anything for you.
I just really think that he needs a better tie.
Thank you. Chris Condon?
Wow, Igor is not only is he saying that he wants to be short the E-mini, but that he thinks that he could be short into the end of the year.
The Fed can only lend and not spend, and sometimes the latter is what's really needed. But to the extent that a $600 billion lending program for small and mid-sized companies could help, what exactly is wrong with the design or function of the Main Street lending program, which has purchased just, I think, $1.4 billion in loans so far? Eric Rosengren at the Boston Fed said recently that Congress
I freaking love the new emojis that we've got on the Discord
it
server.
wants the program.
And when you guys use them here in
Already
chat for the few
appropriated
that have
substantial
joined up.
funds for the 13.3 programs, and these are funds that are explicitly designed to absorb losses. Meanwhile, my colleagues who cover the banking sector say they're being told by commercial banks that the Treasury Department is advising them to target zero losses in Main Street program loans. So, if I may, why is it that the Federal Reserve, the Congress, and the Treasury apparently cannot agree on a loss tolerance that should be applied to the Main Street lending program in a way that would allow badly needed credit to reach these companies? Thank you.
Sure. So a couple things about Main Street. It reaches the whole nation. It's got more than half of the banking industry assets signed up among the banks that are part of it. And it's making loans. The number's more like, it's close to $2 billion now. So the numbers are going up. Banks are joining. Borrowers are coming. And it's significant. It's relatively small now, but it can scale up.
They broke. Oh shit! Oh, they broke the low of the day. Oh my gosh, guys!
If you look out in the lending world,
such a wild day.
Surveys generally
so
find that firms are not citing credit constraints as a top problem, and that
look
is
at
a
the
lot of
stops.
PPP, bank credit lines, and syndicated loans.
These
There's a
guys
lot
are
of
getting
credit
destroyed.
being
There's so many
let out
longs.
there.
This is gonna run.
But you're right. We are looking at some things. We're looking at some lenders are concerned about the underwriting expectations. So banks are going to their approach is likely to be that they're going to underwrite this loan roughly the same as they underwrite any loan. They're keeping part of it, and what we want to do is make sure that that they know that they should take the payment deferrals and other things in place, and also that it's really a facility for companies or borrowers that don't have access to regular way borrowing now. Otherwise, why would we need Main Street? So that's what we're working on, and we'll be doing we'll be making some changes in that respect. I saw what President Rosengren said. I can't really comment directly on that. I just would say that, this is 13.3. If you look at the law under Section 13.3, it's very clear that we are to make loans only to solvent borrowers, and the CARES Act is quite specific in keeping all of the terms of Section 13.3 in effect, including the requirement that we, gather good evidence that the borrower is solvent. This law was amended in Dodd-Frank, and the idea was to make it challenging and put hurdles in place before we made loans. What at the time the thinking was to banks. So now we're using that same law for smaller business borrowers, and it's not a perfect fit. And I would also just say for many borrowers, they're in a situation where their business is still relatively shut down, and they won't be able to service a loan, and so they may need more fiscal support.
Bow down now.
Having said
I'm all
that,
over the place
we're
here.
continuing to work to
finish this
improve
last.
Main Street, to make it more broadly available. Make it available pretty much to any company that needs it and that can service a loan.
Could you just very briefly address the reports that the Treasury is advising banks to target zero losses? Is that appropriate?
I can't say. I don't know about that. I haven't heard those reports. Again, if you think about it, we're going to have to go through the banking system to do this. We're not going to have 100,000 or 1 million loan officers working for the Fed and the Treasury. So we're going to go through the banking system, and the banks like to make good loans. That's what they do. They're trained to make good loans. So you should expect that we expect that they will do some underwriting. We also want them to take some risk, obviously, because that was the point of it. And the question is, how do you dial that in? It's not an easy thing to do, and we're getting some loans made, and we're hopeful that we'll clarify this, and that credit will continue to flow.
Thank you. Chris Rugaber.
Hi, thanks for taking my question. Chair Powell, you've talked a couple of times about parts of the economy that may not recover as fast as we've seen so far. Presumably you're referring to, airlines, hotels, other sections, parts of the economy that rely on close contact. How are you thinking about that in terms of its overall impact? Is that sector large enough to, say, keep unemployment above, far above your maximum goals? Are you expecting that to come back with a vaccine, or are a lot of those folks going to have to find, new jobs and new industries? And should we expect the Fed will keep rates at zero until all of that reallocation is done? Thank you.
Yeah, of course we can't be really sure we know the answers to those questions, but I would say the likely path is that the expansion will continue, and it's, as I said, it's well along, and it'll move most easily through the parts of the economy. It'll still take some time, but the parts of the economy that weren't exactly directly affected, that didn't involve getting people in large groups together to feed them, to fly them around, to put them in hotels, to entertainment, things like that. Those are going to be the places that are very challenging. So there will also be the places that are affected that way, and that's going to be challenging for some time. It just is, and we don't really know how long that will be. It's millions of people. As I mentioned, we had 11 million, something like 11 million people in the payroll survey have gone back to work out of 22 million who lost their jobs in March and April. So that's half of them. So 11 million, particularly if the pace of returning to work slows down, it's going to leave a large group of people.
Banks and
it'll be very
my Wells Fargo company calls.
And our commitment is not to forget those people.
Somebody
as I mentioned, we want the sense of our forward guidance is that policy will remain, as we've said.
The problem was Jay Powell took too long, and the market didn't like him. Right?
Expansion is well along, really very close to our goals. And even after, if we do lift off, we will keep policy accommodating.
I can't believe
until we actually have
that stop run when they broke the lows of the day was
for some time.
crazy.
So those are powerful commitments that we think will support the full recovery, including those people, as long as it takes.
Now let's find a bow down emoji.
Thank you. Mike McKee?
Mr. Chairman, Michael McKee from Bloomberg Radio and Television. Based on what you were just saying about keeping policy accommodative for a very long time into the recovery, lower for longer, as far out as 3 years in your latest projections, is that basically it for the Fed? In other words, since interest rates are your main tool, the things you can do would push down on interest rates. But is it the case now that the only additional stimulus that can come to the economy is from the fiscal side?
The heck, this emoji is ridiculous.
No, I wouldn't. I certainly would not say that we're out of ammo. Not at all. So, first of all, we do have lots of tools. We've got the lending tools, we've got the balance sheet, and we've got further forward.
Oh crap! I didn't mean to do that. Oops.
This is the kind of guidance that will provide support for the economy over time. The idea being that policy will remain highly accommodative until the recovery is well.
I don't know if they have any more.
And will remain accommodative.
They're going to have to pull back
after we lift off.
That was like
that's
everybody got
a really
blown
strong
out,
place for rate policy to be. But again, we
out.
have the other margins that we can still use. So no, certainly we're not out of ammo.
If I could follow up, in terms of the balance sheet, are you concerned that your actions are more likely to produce asset price inflation than goods and services inflation? In other words, are you risking a bubble on Wall Street?
So of course we monitor financial conditions very carefully. These are not new questions. These were questions that were very much in the air a decade ago. And more when the Fed first started doing QE. And I would say if you look at the long experience.
He covered half of that too. That was such a good trade, man.
The longest in our recorded history. It
added to that and everything. Holy shit.
And low rates for 7 years. And I would say it was notable for.
I think he was just really fucking lucky, but holy shit.
Of some
such
sort
a
of
good
a financial
trade.
bubble. A housing bubble, or
in chat, one of our long-term guys in Discord,
popping of which could threaten the expansion.
He went short,
and frankly, it hasn't really happened around the world since then.
He was short going into it, and he went. He added to it after it went up.
Carefully, after the financial crisis,
I don't think that he was planning on it for the reason that it did and everything.
We look at it.
He ended up getting
from every perspective. The FOMC gets briefed on a
These
quarterly
institutional
basis.
cell programs
At the board
also.
here, we talk about it more or less on an ongoing basis. So it is something we monitor, but I don't know that the connection between asset purchases and financial stability is a particularly tight one. So, but again, we won't be just assuming that. We'll be checking carefully as we go. And by the way, the kinds of tools that we would use to address those sorts of things are not really monetary policy. It would be more tools that strengthen the financial system.
Thank you. Don Lee?
Chair Powell, I'd like to ask you about the labor market. As you know, in August, there were about 30 million persons claiming unemployment benefits. Yet the BLS jobs report for August showed about 13.5 million unemployed, only about 6 million more than before the pandemic. I wonder how you reconcile that and what you think the actual labor market conditions are.
So, I think the overall picture, take a step back from this, the overall picture is clear, and that is that the labor market has been recovering, but that it's a long way from maximum employment. I think that's the bottom line on it. So within that, though, take claims in particular, the number of claims, the quantity of claims, and frankly, the fact that PUA claims are new, the pandemic unemployment assistance claims, that's a new system that had to be set up. The actual counting of the claims
Yeah, this is probably going to have to come back up. But then if they come back up to 33.90,
much signal about the
95 or
particular
so,
level. So
they might just
because
bounce
people
right
were
off.
setting those systems up, and when they got them set up, they counted them all at once and things like that. I think, though, what you've seen is that the level of, certainly the level of initial claims has declined very sharply from the very high levels of March and April, and is now at a lower level, continues either to be flat or gradually decline. It's worth noting, and that's good, it's worth noting that that level is maybe 5 times the level of what claims were.
Okay.
Claims were around 200,000. Now they're 900,000 in that range weekly for initial claims. So that just tells you the labor market has improved, but it's a long way from maximum employment, and it will be some time getting back there. I think that's the best way to think about it. In many parts of the economy, there's just a lot of disruption, and it's really hard to say precisely where we are. I'll give you another example. With we say unemployment's 8.4%, but if you count those who are misidentified as employed when they're actually unemployed, and you add back some part of the participation number. So if you had a job and you were in the labor force in February and you lost it because of the pandemic, some of you are now being reported as out of the labor force. But I would more look at those people as unemployed. If you add those back, the level of unemployment is probably 3% higher. On the other hand, by that metric, the unemployment rate would have been in the 20s in April. So the improvement has been quite substantial under any measurement, but the level is still quite high.
Well, if I could follow up, is it the Fed's aim to get back to 3.5% or even lower?
Yes, absolutely. I can't be precise about a particular number, but let me just say there was a lot to like about 3.5% unemployment. It's not a magic number. No one would say that number is the touchstone, or that is, maximum employment. I would just say you ask about 3.5%. A 3.5% unemployment rate showed, gains being shared very widely across the income spectrum. In fact, going more to people at the bottom end of the spectrum. It showed labor force participation coming up above many estimates of its trend, as people who'd been out of the labor force were being pulled into a tight job market. There's a lot to like about a tight job market, particularly in a world where we didn't see inflation. So yes, we'd love to get back to that. I mean, I'd say we would like to get back, rather than to a particular number, we'd like to get back to a strong labor market where wages are moving up, where people can find work, where labor force participation is holding up nicely. That's what we really love to get back to. Now, of course, we need inflation to perform in line with our framework. But the good news is we think we can have quite low unemployment without raising troubling inflation.
Thank you. Nancy Marshall-Genzer.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, I want to follow up on the wealth gap issue. I know you were saying that you have limited tools, but are there things that you can do possibly in the area of research and maybe expand your research on racial economic gaps?
We do. We are gifted with a
Daniel says, don't educate people who
really
think magical levels is what matters.
We do
Yeah.
a significant amount of research on racial disparities across multiple variables, including wealth, as you ask about. So we do.
Oh, right. When I was tweeting about Jerome Powell and why he has a half Windsor, and they said, and we thought he had access to a full range of tools.
Community affairs groups, they're present in communities around the country. So it wasn't just the Fed Listens events. It's more just over a long period of time we are in contact with people in those communities to understand their experience of the economy. We serve all Americans, and we know that, and we're going to use our tools to reflect that fact. So the answer is yes, we do quite a bit of research, and I suppose we could do more, but we really do a lot, and we contribute to those fields and those assessments of the state of the economy. And we do that not just because it's interesting and important, but because it's important for the economy and important for our mandate. We are assigned maximum employment. Now, what does that mean? As I mentioned earlier, it doesn't mean a particular headline unemployment number. What it means is maximum employment. So we look at that in many, many different variables, and we ask ourselves whether those variables or those labor market conditions are consistent with our assessments of what would constitute maximum employment. And that would include all of the things that we're talking about.
Let me try it again.
Thank you. Greg Robb.
Hi, Greg Robb from Market Watch. Thanks for this. I want to go back to the new forward guidance that you have. And you say that it's powerful, but you've already have two dissenting voters on it. And
So now,
I was wondering if
he
there's
said I can
other
share this
people
with you guys. So
argued
what
against
what
it.
happens when the
And
market
what do you
trades
say
lower?
to the two who dissented? It
Let me
looks
just
like
turn this down a
President
little. Oh, actually, this is
wanted a
important. Let's see
simpler
what they said about
forward
it.
guidance, and President Kaplan thought that the current guidance you have was fine for now. So, like, how did you argue back on those arguments? Thank you.
I wouldn't. I don't want to comment particularly on the two dissenters, but they dissented from, of course, different perspectives, and that should be clear. That's they're sort of on two sides of the discussion. But I would say this, I am blessed with having a committee of highly thoughtful people who bring diverse life experiences and diverse careers, and of course diverse views to our work, and I wouldn't have it any other way. I wouldn't. So I would just say in our discussions the last couple of days, the whole committee, everybody on the committee, is very supportive of the statement on longer run goals and monetary policy strategy and what's in there. Very, very broad support.
This stat that
unanimous
he sent
support
me
for
is
that.
really good.
Everyone sees the changes in the underlying economy and sees in their own way the need to address those, and including the changes we made to the employment mandate and to inflation, so that we're now flexible average inflation targeting. Of course, we're the first.
So the stat that Pivot Trader
there's no
in
and we,
chat sent me.
This is the first guidance under our new framework. So of course there would be a
So
wide
since
range of views, and you would
2018,
expect that. And it's actually a healthy thing.
what happens when the market trades lower from 2
also
to
say
the
this,
close on FOMC announcement?
This is all about credibility. And
Since 2018, this has happened 18 times. Of those 18 times, the market was lower the next day by an average of 13 points, 75% of the time.
very good first step.
The T statistic on that would be negative 1.78, which is pretty significant. The last time this happened was actually at the last meeting,
We had quite a robust
where the market traded 100 points lower into the 9:30 open the next day.
That's just
Therefore, there is little reason to be long overnight from our analysis here. Any permutation of combinations of ups and downs closes has resulted in a negative outlook for tomorrow. Having said that, this has only been the case since 2016. Prior to that, the stats on this event are not very conclusive. Happy trading.
Hi, Chair
And remember, past performance is not indicative of future results. But given the fundamental backdrop and the reasons why I think we're seeing this drop, I think that, being short into tomorrow would be an okay trade. Of course, I'm not going to do that. I'll just come in tomorrow and maybe we'll have the opportunity to sell things tomorrow. We'll see.
So thank you for that question. We've actually spent quite a bit of time on this, as Secretary Mnuchin, I think, mentioned the other day. And I'll say just a couple of things. First, our facilities are essentially always, they have to be under the law, broad-based and not so much targeting any single sector. Also, it's important to remember that CRE, commercial real estate, benefits from several of our existing facilities. So the TALF takes commercial mortgage-backed securities and SBA commercial real estate deals, and the New York Fed purchases agency CMBSs directly. In addition, I would say Main Street helps businesses pay their rent. So we're helping real estate, in a number of other ways, commercial real estate. Also, CMBS issuance has resumed. Spreads have tightened on CMBS. There are a couple of issues. One is just that commercial properties with CMBS loans often have covenants, uniformly I think, have covenants that forbid them to take on more debt. So you have a situation, where you, without a legal change or some kind of an innovation that defies discovery so far, you have a hard time providing mass relief with regard to real estate that's in commercial mortgage-backed securities. So we're still working on it. We're still looking. I would say it may be that further support for commercial real estate will require further action from Congress.
For the last question, we'll go to Brian Chung.
Hi, Chairman Powell.
They selling that
it seems
shit.
like a lot of the
Look
new
at that.
inflation framework is about shaping inflation
That is
expectations,
another
but the average
ugly,
American that might
ugly
be watching this might be confused as to why the Fed is overshooting inflation. So what's your explanation to
Still
Main
haven't.
Street,
Okay,
to
they did. They
average
broke
people,
yesterday's
what the Fed is
low.
trying to do here, and
Not
what the
not
outcome will be for those on Main Street?
not the overnight low. Yesterday's
Very
regular
important
session
question,
low.
and I actually spoke about that in
It's
my
still an
technical remarks a
important
couple
level
weeks
that
ago.
they broke.
It's not intuitive to people. It is intuitive that
This is
high inflation
bad.
is a bad thing. It's less intuitive that inflation can be too low. And the way I would explain it is that inflation that's too low will mean that interest rates are lower. There's an expectation of future inflation that's built into every interest rate, right? And to the extent inflation gets lower and lower and lower, interest rates get lower and lower, and then the Fed will have less room to cut rates to support the economy. And this isn't some idle, academic theory. This is what's happening all over the world. If you look at many, many large jurisdictions around the world, you are seeing that phenomenon. So we want inflation to be, we want it to be 2%.
Well, the easy trade is already
we want it
passed,
to
of
average
course.
2%. So if inflation
Well, we
averages
could have gone
2%,
short at 3,400.
the public
We
will
would have been
expect
okay,
that,
but
and that'll be what's built into interest rates, and that's all we want. So we're not looking to have high inflation. We just want inflation to average 2%, and that means that, in a downturn these days, what happens is inflation, as has happened now, it moves.
I don't know if it
down
was moving
well below
because of what you
2%.
said there. Or what.
And that means that we've said we would.
'Cause
we
I thought it
would
was a
like
good
to see, and we will
explanation.
conduct policies so that inflation moves for some time moderately above 2%. So these won't be large overshoots, and they won't be permanent. But to help anchor inflation expectations at 2%. So yes, it's a challenging concept for a lot of people, but nonetheless, the economic importance of it is large, and those are the people we're serving, and we serve them best if we can actually achieve average 2% inflation, we believe, and that's why we changed our framework.
Thank you very much.
Thanks very much.
No. You can't hear that. That didn't happen. You didn't hear that. YouTube, you didn't hear that. Well, guys, I think we need to stick around and see what happens into the close. Yeah, it's hot in here, by the way. I have been way too. Why that one is down, but whatever. Okay, so that one recovered back really quickly. I was kind of like, oh, I could just try and run with that one, but I think this is the case of the first trade is the best trade. We got the first trade. This if we took it short, that would have been good too. But now that that's gone, and trying to make up for it, it would be bad. So, and I've already pressed my luck enough today, man. Like, holy shit. Holy crap, man. Okay, some absorption there. Hold the boat. Oh, there was a lot of orders through at 33.84. Oh, man. Okay, well, I'm going to take a quick break. But I'm going to keep filming this for historical sake because that was crazy. And we'll do a little bit of reading. Algo Lover says they need to hold it above 33.67 for continuation, 34.24 target. If not, anticipate a deeper pullback. That's still a long. I don't know if it's can be still be a long algo, but okay. You're trying to buy when they're selling, you're gonna be wrong 99% of the time. Well, they break through everything. 33.88 would have bounced if they didn't want to break the market. Yeah, no, they that was that impetus right there. I don't know that. So I was saying, I'm wondering if there was something that he said there that caused them to do that because they're already washed everybody out. I mean, they're screwed. And in a situation like this, so you can always look at it like, okay, here's everybody that's been in today. And here at this point, anybody that's gone long today is out of the market. So it's really hard for it to go further because you need more people to jump on. But how many more people are going to jump on FOMC day? It's a little questionable, right? So for them to have just absolutely careened down like that would suggest another news catalyst, but I don't see what it is. But the way that it's sinking, and there has been a lot of volume here. Okay, at 84, I'll show you 33.84, lots of volume there, 10Ks. So if we close below that today, that is a lot of people that lost money on this move. Like that is going to have repercussions for a long time. All those retail traders that have been like pumping the market up, they're going to be sore tomorrow. Low volume moves fast tomorrow. Up, maybe. So if you had missed it before, we got a stat here from our buddy over in the Discord saying that since 2018, if we trade lower into the close after the FOMC meeting, that 75% of the time we're lower the next time. So that's a pretty solid overlay. Of course, past results aren't indicative of future results, but I think there's some fundamental reasons why that would be true. And here we have a fundamental that is bearish. And remember, the fundamental that is bearish is that the statement was extremely positive, but the positive statement can partially be considered discounted because we already knew about average inflation targeting. And meanwhile, there's no indication that we're going to get any more treasury purchases, asset purchases at all, which means that the Fed isn't actively pumping the market. That means that the sell that we've had can continue to go on. right? I think that's why they're selling that, and maybe the dissenters. So yeah, and so you add on top of that people just losing a lot of money on the move and getting head faked. That kind of tends to lead towards more extended moves. So I would watch out. That said, for all we know, it might recover it in the end and go back up to 3,400 for the end of the day. We'll see. We got 15 minutes. I'm going to go to the bathroom real quick. 10 minutes, we got the market on close. Then we'll really know what the deal is, right? Okay. Back to 33.84. To save ES for tomorrow, they need to close above 33.96. Yeah, you're probably right. That probably does require more than just retail traders. Well, that's the thing is that I'm getting at is I don't think that you can rely on the retail traders here at this point. I think that they're either going to not be trading FOMC or be completely clueless or have just gotten destroyed and crying and not wanting to trade it. Could be wrong, but man, what should we use for the today's title? I'm thinking back on it, and the thing is I had that along with one contract going into the meeting, and the micro futures stopped it out. That's such bullshit. Such bullshit, man. Because that would have been an amazing trade. Would have been just as good as what I got, but whatever. Whatever. Would have been better, in fact, I think. Still trying to decide what I'm going to use for the title. going to say, I escape with a long trade before market rolls over. What a day. Well, I don't know, man. You shouldn't have put that number up there, Vlad. They're watching and they're like, okay, well, for Vlad's sake, let's get it up there then. They're going right for your number. No rate hikes until 2023. Let's ride those horses to glue factory. The way you think about the sell, Gary. I see some guys selling it. I don't know. I think that we may still have some bearish action this week, even if they recover this. They do look like they're recovering it though. It looks to me like some guys bought the dip and they're going to win out. Now we'll see what the what the market on close will do. It will really matter. Retail sales came in soft. I didn't really think the retail sales was a huge deal though, to be honest with you. Although I do have to wonder, this move, I show you, something weird was going on in the tape. Actually, I'm a little too zoomed in there. Okay. So I caught this long and held it and let it come all the way back on me. This move right here had a really strong offer. And it wasn't until they got off of here that they finally let up off of it. So and because it was an offer, and usually the E-mini moves towards those, kind of makes me think that was a really big hedger hedging themselves or exiting a position, frankly. Because, I mean, if you're exiting a position, you want to be passive about it, right? You don't want to shove the market down. So that whole thing was kind of interesting. And then we get the long. It does end up breaking the high. I caught some of that long, but I sweated it out. Super crazy. And then they rolled over. And I think the reason they're rolling over is because of the asset purchases. The reason I think that is because the dollar has gotten stronger off of this. And, oops, wrong button. The 30-year treasury in particular got demolished here. Whole point down. Whole point down. So yeah, it looks like after the close there, after they what is the word? After the options bit closed, it balanced back up again. But okay, so there was the market on close. So it's a lot of movement, but I'm not sure which direction it is. Yeah, the pullback was kind of stupid looking. Yeah, it really messed me up, man. I felt really confident in my trade. I was like, they're going to want to buy this into FOMC. I bet you they will just be able to hold it and this and that. Nah, I'm just going to believe the stop and not look at it. But I was sweating there. I mean, it was causing me grief the whole time. And then it came all the way back. And I'm like, you stupid, 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 stupid. I felt so dumb. Is that my mom? That's my mommy. So yeah. Yes, the $120 billion a month, but Powell talked about fiscal stimulus is needed. You were drunk trading. It could be, yeah, GG. Yeah, so I think it's because they're afraid that they're not going to buy as many treasuries and junk bonds and so forth. And if that's the whole reason for the rally, then that's a problem. But I think from the Federal Reserve's view, they just can't do it anymore because it's affecting the market too much. Like maybe we need more stimulus, but that's probably not the way to do it. If we don't pass the $2 trillion stimulus bill, both sides are playing a game of chicken, right? Well, did you see today Donald Trump was tweeting at the Republicans and saying, you know, like, err on the side of going too big. Of course he would say that. I don't think that the other Republicans feel that way. But apparently Democrats are facing a revolt over there. I wonder if I kind of just saw stuff about that on Twitter. I haven't really gotten a chance to read the political news today yet. But I apparently some of the Democrats are kind of revolting a little bit. No, I don't really got anything in here. There you go. Senate Republicans shrug off Trump's call for a larger COVID-19 relief measure. So that settles that one. But I don't see anything about the Democrats. At some point, there's going to be some Democrats saying, like, let's just pass what we can. It's going to happen. I think Nancy is just insane to be doing what she's doing. Your eyes are red now? Are they really? Nah, they're fine. They're always that red. Powell said they did what was necessary and will continue to do so. He did say that. What did Trump say? He said, Republicans, you need to get something passed and, you know, err on the side of going bigger. Okay, so they did buy up there. They were recovering, but it does at the moment look like they could close below 33.84, and we got about 7 minutes left. The market on close orders, I'm not sure. I mean, there wasn't like an obvious impulse off of it right at the beginning there, but we did eventually move lower. So if we close on these lows of the days, that's super bearish in my opinion. Let's go over to the news websites and see if I'm right about why there's other theories about why we're moving the way that we are. Wow, Facebook censors Tucker Carlson's interview with a rogue Chinese scientist. That whole story is weird. I don't 100% trust her, to be honest. So they said that she had smoking gun evidence, but it wasn't a smoking gun. So I already feel like they're just overhyping it. Hundreds of overseas ballots list wrong running mate for Donald Trump. Now this is all old news. S&P turns negative despite Fed's pledge to keep rates near zero. Tech stocks lead losses. So they're not saying it. Of course they're not, because there's edge in it still. I'm telling you, I think that's why. I think the reason why they're doing what they are is because the treasuries no longer believe that the Federal Reserve is going to increase the size and duration of asset purchases. I mean, I don't think that they believed it was going to happen before, but now they're like really sure that it's not going to happen. And that is pushing rates up. And that is really painful for the equities at this moment. And in particular, it strengthens the dollar. And when you see that dollar strength coming in and above 93, it's really ugly because there are a lot of dollar shorts out there. It is such a crowded trade, the dollar short. So when the dollar is moving up, it causes a lot of drama. Yeah, tech is dragging the other indexes down, which would make sense. Because it seems to me, so here's another thing we haven't talked about yet, but I feel that the market is overvalued. But when you look at where the market is and you take all of the techs out, we haven't broken a new high and everything. So maybe the other stuff really is like not crazy overvalued, right? So it would make sense that if we're going to come down, that tech is going to suffer the vast majority of the losses, right? They going to close at the lows, man? Haven't broken a new low yet. They're so close though. Okay, well there it is right there. But that's a stop run if I ever saw one. Oh my. They absorbed that stop run though. Look, 500, 600 traded through there. Almost traded instantly. In my opinion, if the 10-year breaks 1%, that's a new line in this. Well, but what are we at? Oh, look. It already has it there for me. We're at 0.69. We're at 0.69. We'll call it 0.7. Okay, so 30 basis points. Let's go to the CME. Let's calculate this. Let's calculate. Hopefully I can... Oh, I might need to open up Chrome. I might need to open up Chrome. Badum. Two minutes left. Markets. Interest rates. Let me log in. Hopefully it'll let me log in. Maybe not. Maybe not. Tools. $86.50. Okay. Times 30 basis points, right? 2,595. So that would have to be somewhere around 137. Okay. That looks pretty far away to me, Gary. Unless, the interest rate can move independent of the price in to some degree, right? You're saying that was about 130 in price? No, it would put us about 136 and a half. Something like that. Okay, there's the close. 76. So they did close below where that high volume tried to buy the dip. So that's a pretty ugly close. Yeah. Like when based on my model and remember that this is all yes, you're right, Tippy. Yeah. You can't fight institutions. Told you that 33.96 was recovered. So was sad for retail typo. Oh yeah. Oh, it was a typo. We didn't mean 130. 130 is way too low. Yeah. 136 and a half or so. We would have to break. We'd have to break much lower off of the most recent. Well, let's open up a new ZN chart here really quick. Yeah. Like remember that move down in August when things got a little hairy. we'd have to go below that, right? Because it's about 136 and maybe 16, let's say, right here. Now there is a moving average over here, so that might also be a technical level that people will look at. But you're right. If it goes down, if it starts doing that, and look at the way that it's been. Well, that was the move, right? So if they're able to get to this low right here that we had in June, then yeah, the market will really freak out. Market will really freak out. I'm not so sure if that can really happen. I'm gonna think that the way things are right now, that it's probably pretty pegged here. I think it'd be really hard for them to move down significantly from here, but never know. Crazier things have happened. 10 and 30 are pinned in a range. They will do wind sprints within the range. Yeah. Well, I got to tell you, Gary, I've had a really hard time trading the treasuries lately because there will be these freak moves out of nowhere. It's like I'll be sitting in a trade for like an hour. I get 8, 10 ticks, and I'm like, this is great. I'm doing great. And then all of a sudden, for no reason, it'll just come completely back. And you're like, what's going on? It's crazy. And I think that in some cases what happens is a big buyer will come in and buy it up, and then when he's done buying, the market makers immediately snap it back. You had a nice day in energy stocks? Well, oil is still up, isn't it? Yeah, it is. Pretty nice. Oh, man. Okay, well, you know what, guys? We just wanted to see the close. We closed lower. I think that what just happened was pretty bearish, and I can't believe. Oh, do you remember back in 2017 and 2018 how fun trading the 10-year was? I don't necessarily remember it being fun. Where is that? We're going back. Like, I remember 2017 in particular being really slow. That was so frustrating when the volatility was like, before the first volatility explosion in that February of 2018, right? Okay. When the volatility explosion happened, I remembered. Yeah, you've been around for a long time, Gary. You guys are so great. We really, after this pandemic is over, we really got to get together, everybody. So many as we can, at least. Because it's just, to me, it's just mind-blowing that we got this group of guys that you guys are here. Because they say, the majority of day traders, they lose money. And I'm sitting here like, so then how do I have so many guys that stick around for years and years and years and are so great? Like, how are we doing that? Anyways, I remember that when it was Donald Trump just got elected, that was fun. But then after that, it was like the volatility disappeared and you couldn't make anything. I had such a hard time. I had such a hard time with that. Remember, end of 2017 and January 2018, fall spiked hard. Yeah. Because what kept happening to me is it would be like really slow and I wouldn't do very well. And then I was all like ready and rearing to go, and like the volatility came, and then I would kind of screw it up. I know. I've been through a lot of phases. I feel so good about what I've been doing. There's still some problems. I get these drawdowns, man. Like today's trading is a little embarrassing, man. I made money, but it's a little embarrassing that I had to get a $130 win to come out profitable. Because if I had not done all of these and I had gotten my $70 off of this one, I could have made $200 today. And this one too, by the way. That one, I almost feel like that the micro ES went down there just to tag me. Do you see that? The micro off of the news went all the way down to like 88. 34.88 or something like that. And the ES didn't even go below 95. So it was like a 10-point slippage between the two of them. Yeah, best to use demo on a day like today. I don't know why I took as many trades on my live account as I did, but pretty much all of that was on live. Shouldn't tell you that. It's all sim trades, guys. Those are all sim trades. I ain't got nothing. I suck at this. I'm not very good. Don't follow me. I'm all trading sim. I'm just a scammer trying to, well, I'm not a scammer, but I'm just some crazy guy that's just streaming to have a YouTube channel and get the attention. And there's no real actual edge in anything that I do. So don't watch. All right. I am honest though. I always want to say, I have these people hit me up on Discord all the time. Like, hey, do you want somebody to promote your Discord? It must be the same person. It's never going to happen. Have strict rules. We're always going to be good at it. Because the whole point here is to get good at trading, not necessarily to make money. If we get good at trading, we should make money. But, if the point was to make money, there's probably a ton of things that we could do to make money. It wouldn't be the most honest. It wouldn't necessarily be the best things for you guys. But alcohol in barrel amounts works well. You're talking to Salim there. I can't afford sleep medication. Dude, be careful about that stuff. My little sister was on Ambien. I think that might have been part of why she killed herself, to be honest. I'm gonna have to rest today. I mean, I'm gonna work out, but after that, because when I took that long after the FOMC, the one that I made a ton off of, I was sweating. I was so nervous about that, man. Like when it got up there, I just wanted out. I was like, well, it can go more, but I just want out. There's a spot. I got what I need. Let's not overstay our welcome. Okay. Too much yapping. Tomorrow. So, in the meantime, stay profitable.